Hello, this is David Jensen with your May 31, 2023 Economic and Markets Update. The title of today's presentation is Signals of an Oncoming Crash. First of all, if you do like this presentation, please give the video a thumbs up. And these four platforms are the social media platforms where I post my information. Okay, back in July 2022, I posted a presentation on my Substack called How the Fed is Collapsing the U.S. Economy. And the predicate for that presentation were that the crash drivers that were visible then after the Fed had increased the M2 money stock by 42% and the true money stock or true money supply by 60% in 2 years was the fact that they were spiking interest rates because of the raging price inflation, and that increase in interest rates was going to have a highly predictable negative impact on the economy. With $90 trillion of system debt at that time, by the way, that's now over $94 trillion. That each 1% interest rate that the Fed was applying would add a $900 billion per annum added burden on the economy, and that it couldn't possibly sustain that. We're now at 5.25%, so over $4.5 trillion with time of an added interest rate burden on the economy. The second aspect was that the Fed had created over decades a completely debt-dependent economy, and the really precipitous drop that was even visible at that time in the money supply was going to take away market liquidity and economic liquidity that would crash the markets and the economy as it continued. So let's have a look here at the money supply. We now have a money supply here which is contracting at the greatest rate since the 1930s Great Depression. By the way, this graph, this true money supply and M2 graph is provided by Ryan McMacken there at Mises.org. Only place I can find this graph with the TMS, it's the Rothbard-Salerno measure, and I think it's probably the dark blue line there is the Rothbard-Salerno TMS, and I think it's the most accurate one to follow. The Fed's M2 is also posted on here. But a couple of things to note here is that this is the year 2000 here. The vertical lines are when there's been economic recession and market disruptions. And what we can see here is that they had a negative or a contraction in the TMS, and the M2 approached zero back in the mid 90s. But at these periods here of an increase, this is the annual rate of change of the money supply. And you can see here that as we go along in time, that these periods of net positive increase in the money supply become longer and longer duration. So the amount of money injected into the economy becomes greater and greater as this is extended over a longer period of time, and is an indicator of the increased debt dependency and money printing debt dependency and money creation dependency of the economy. You can see here that the TMS up to 18% per annum there after 2001. And running, mid 15s here for a period, and then continuing on. And also that fact here is that in 2019 that the Fed already had to start increasing the money supply, because we saw there in August, September, the disruptions in the New York, the repo market there in New York, and the Fed having to step in and then drastically increasing the money supply there after 2020. So 40% per annum increase year over year on the true money supply, 27% with M2, and the net increase there was 60% of net increase in the money stock of TMS and 40% increase in the M2. And also the thing that we can look at here is the fact that now we're seeing this tremendous contraction that's happening. So negative 10% year over year contraction in the TMS, and right now about a minus 5% in the most recent quarterly numbers there from the Fed. Again, we have an economy which has become dependent on credit creation, debt creation, as opposed to increase in productivity for consumption. So this contraction in liquidity, in the availability of debt, has a very, very drastic impact on both the economy and the markets as it continues. So we can see here what a couple of points here looking forward for the signs of the where we expect the impact of the liquidity contraction to be the greatest. And we see this record liquidity removal from the Fed. It will collapse the Fed's tech bubble that it has created. Here we're looking at the beginning of 2020. You can see how the tech stocks exploded versus the Russell 2000. So this graph is a ratio of the NASDAQ 100 tech stocks primarily versus the Russell 2000 small cap. So that's more representative of the general economy overall. And we can see that ratio of how the tech stocks absolutely took off with the addition of the record money printing by the Fed there in 2020. And we're now back at the record levels of the ratio there, right back to the tech bubble of 2000, the dot-com bubble. So we'll expect this NASDAQ bubble, tech stock bubble, AI or no AI, to correct back to a more reasonable level. And we're going to see that probably very shortly here as the Fed continues to take away the liquidity that it produces that juices this market. The next signal that we're looking for here in terms of an economic correction is the fact that the rising rates, they will impact the banks with debt default. The prior three presentations I've given in April and May address the fact that we've already seen a $2 trillion hole in the balance sheet of the banks from the rising rates, devaluing the assets on the bank balance sheets, which are not marked to market, but we know what the impact of the interest rates is on these banks. And then also these presentations warned of a second leg of bank destabilization, which would be the increasing default on loans and bonds, and we expect to see the high yield junk bonds decline greatly in value first, because they are the least creditworthy borrowers. So here's a couple of headlines. May 25 from Bloomberg. Investors face losses of 80% on leveraged loans as defaults rise. Leveraged loans are repeat borrowers in the credit markets and are the least creditworthy. Here's another headline from Bloomberg, May 23. Looming defaults threaten chain reaction from credit into stocks. And it says here, stock market volatility feeds off wider high yield bond spreads. So the high yield bonds, the rates are starting to increase, reflecting the increased risk in these assets. This is not about the debt ceiling that picture might seem to indicate it, but it's the article is about the fact that we're seeing increasing, a slow turn, but an increasing rate of defaults in the high yield junk bond sector. Another signal that we see here is the repeat bankruptcies are rising. This is a Bloomberg graph here, and it shows that the repeat bankruptcies of large corps now has reached back to the level of 2009 there during the great financial crisis. So again, repeat bankruptcy filings reflective of these least creditworthy borrowers. And the junk bond leveraged debt market would be the one that we would expect to see decline through a higher risk premium and higher interest rates, and they're likely to be quite substantial. And finally here, a note here is that looking forward, that we're seeing the inflation expectations are starting to break out again. With that much money creation, 60% of the TMS money stock increase in a couple of years. Goods price inflation is a consequence of an increase in the money stock, and no economic contraction is going to meaningfully cause a decline in goods prices for a sustained period, given the level of money printing that's gone on. You might have a stabilization of the increase somewhat, but the amount of money that's been created and then the Fed's proclivity to print means that we're going to see higher prices and thus higher yields and less liquidity in the markets and greater destabilization of the banks going forward. So this measure here is of the 5-year Treasury versus the 5-year forward break even of the inflation adjusted bonds. And it's an indication of markets' expectations of inflation going forward 5 years. And we can see here that this is, appears to have broken out of this consolidation wedge here. And as would be expected now, given the amount of money that's been printed, we would expect to see this breakout to a higher level. So here's one signal from the market that we're going to have higher rates, less liquidity, and greater problems in the financial sector. So this is a summary slide here, but the net is that the monetary central planners are popping their monetary and economic and speculative bubble. We've had this increase of 60% of the TMS over 2 years, and it's driven speculative bubbles and goods price inflation. The Fed is now spiking the rates of interest rates, and there's being a shock liquidity withdrawal is being applied to the markets. So, as noted, they're adding a $5 trillion per annum of added interest burden to the economy. The bank losses will further mount with visible onset of debt default, greater provisions having to be made. Impairments of the balance sheet of the banks is going to result in set-asides by the banks for these losses. Expect to see the most speculative sectors first. Tech stocks and junk bonds will lead this decline in the markets and the economy. This is being driven by goods price inflation, forcing the interest rates higher. And the problem that we have now is a malstructured economy that's completely dependent on credit creation, as opposed to organic increase in productivity being disrupted. And this is going to place treasuries of the US government that they're issuing at risk. Both short-term and long-term treasuries face losses ultimately as price inflation continues to persist going forward. If there is a market crash, yes, it's likely that especially the front end of the curve, the shorter-term market, there will be a decline in interest rates. But I think what's going to be unusual this time is going to be both the short and the long end of the curve. Ultimately, the rates will continue higher with a decline in the value of these assets, driven by monetary debasement by the Fed and price inflation continuing. A final note here is that the Federal Reserve's Board of Governors presentation there that was released in April, it showed that they were aware that in September 22 that the Silicon Valley Bank had already lost 110% of its capital through rising rates. So basically that bank had ruptured. There was a bankruptcy there, but that bank continued on for pretty much 6 months before it blew up. So from this we can take away that there are more bank failures lurking in the market. The Federal Reserve's presentation indicated there were 722 banks back in September of 2022 that had already lost more than half of their capital. And the estimate is now that there's up to 2,000 banks that have lost more than half of their capital. And we can expect there's quite a substantial number of these which will be fully bankrupt but not yet recognized by the market. So I will leave you with this slide as we end 110 years of monetary central planning. Think of silver and gold in terms of safe haven assets. Okay, that ends the presentation for today. Again, these are the social media platforms in which I post information, and thank you very much for your time.